In this video, we'll be going over exactly what happens to your IRS Form W-4P when you submit it to your payer. So IRS Form W-4P might be the most frequently asked question that I receive on my YouTube channel. So I wanted to create a video that outlines how the instructions work for your payer. Basically, this form gives very specific guidance to your payer, which we'll define in just a moment, based on a publication known as IRS Publication 15T. So your payer must follow very specific instructions, part of which is from Chapter 1 of Publication 15T. We'll get to that in just a moment, which is updated annually. This guidance, as well as what you complete in your Form W-4P, specify exactly what your payer will be withholding from your payments. So to do this, we will walk through Worksheet 1B of Publication 15T, which is also known as the Payer's Worksheet for Figuring Withholding from Periodic Pension or Annuity Payments. This is the exact worksheet that will give your payer guidance and instruction on how to calculate your tax withholdings. Before we go through this, there are a couple of key concepts that you should understand that we're going to go over. So first, a payer is understood. It's not defined in Publication 15T, but it is understood to be a payer of either periodic payments of pensions or periodic payments of annuities. And Publication 15T, as I mentioned, provides very specific guidance that depends completely on what is contained on your Form W-4P. In other words, the payer has zero discretion on what to withhold, what to include in your withholdings. Everything that they do is based on your instructions on the form and their adherence to the publication. So there is a difference in the calculations for W-4 forms, specifically W-4P forms that were submitted in tax year 2022 or later versus forms that were submitted in 2021 or earlier. So as a pro tip, if you have not updated your W-4P with a 2022 version or later, you may find that your withholdings will be slightly different simply by completing the updated W-4. There are a couple of key differences in the new calculations versus the old calculations. There's one form and one worksheet. So if you itemize deductions, you'll use the worksheet. If you take the standard deduction, you don't need to do this. Conversely, before 2020, the old W-4P had 3 worksheets. You had to struggle to determine which worksheets you had to complete. Some taxpayers had to complete 3 of them, some only 1. Maybe you did, maybe you didn't. There were a lot more variables that were open for interpretation. The new W-4P kind of solidifies all of that, so things are more straightforward than they used to be. There are no personal allowances. So if you remember where you had to count 1 for yourself and 1 for your spouse, then you had to determine if you were possibly eligible for certain tax credits or based on your marital status. All of that is out the window. You used to have different worksheets for different tax situations. You would use one worksheet if you had multiple jobs. All of that is gone. No more personal allowances. The new form W-4P is a little bit more straightforward in that regard. There is no estimating income. You don't have to sit there and wonder whether or not you're going to be eligible for the child tax credit. In other words, you didn't have to guess at your adjusted gross income before you had a realistic understanding of what it was going to be for the tax year. You now have to basically understand whether or not you think you're eligible for the child tax credit or other particular tax credits, but you can make an easier determination simply by going through your tax records instead of having to commit certain income numbers to memory. So there are 4 steps to worksheet 1B. First, adjust the payee's payment amount. Step 2, figure the tentative annual withholding amount. Step 3, account for tax credits. Step 4, figure the final amount to withhold. So these are the steps that your payer will calculate to determine what your tax withholdings are. And we are going to go through a case study in the case of our hero, John Doe, who has recently updated his Form W-4P. If you see here on the right-hand side, this is a common situation that a lot of taxpayers that have asked me questions in the past have basically said, hey, I'm going to leave mine blank. So this is going to be a case study on exactly what your payer will do if you submit a blank W-4P. Before we get to that, what we're going to do is we're going to walk through the different parts of your Form W-4P and how they impact the various steps. So married filing jointly, we'll get to that in step 1C. The earned income number, this is the number that you would enter if you had you or your spouse had one or more jobs. If you would enter your total taxable pay. So in this case, John is married filing jointly. He has no earned income, neither does his spouse. In step 2B2 of the form, we also determined that there are no other annuities or pensions that pay less annually than this one. If they pay more, then you would not be completing this one necessarily. You would be completing the W-4P for the higher pension or annuity, and then including the amount that you earn from this pension in that step 2B2. So in other words, if you had $48,000 in this one and you were completing a Form W-4P for the higher paying one, then you would simply enter $48,000 into this space. Since we have no other sources of income, we're going to leave this alone. Step 3 would be something that if you claimed other tax credits, in this case, we're not claiming any dependents, any tax credits or anything like that. No other sources of income. So if you had interest income that you're expecting, taxable Social Security, dividends that you did not already withhold taxes for, but you wanted to include those in this, you could withhold for your Social Security, your interest payments, things of that nature, and this would instruct your payer to go ahead and calculate the withholding to include that. If you do complete this, then you should not complete the W-4 for the other source of income. In step 4B, deductions, this is the one item that may contain a worksheet, and that worksheet only applies if you're itemizing deductions. In this case, John Doe is not, and then he does not want any extra withholding from his pay. So we're going to transition from this PowerPoint slide to the worksheet itself. So this is worksheet 1B, the payer's worksheet for figuring withholding from periodic pension or annuity payments. And as I outlined, step 1, step 2, step 3, and then step 4 below is figuring the final amount to withhold right there. Okay, so we are going to focus on step 1. We're going to go through this in order as if we were the payer and we're calculating John Doe's withholding. So when we start with step 1, we're going to begin by adjusting the payee's payment amount. The first thing that I want to highlight, however, is the table 4, which is alluded to here in step 1B. So this is what you would expect to see as the payer when you're making payments on a regular basis. So if you're receiving monthly payments, then your payer is going to use the number 12 in determining how much to withhold from each check. Whereas if you're receiving your payments twice a month, then they would divide that number, use 24. Every 2 weeks is 26. Every week is 52, so on and so forth. The key difference right here, however, happens to be the difference between semi-monthly and bi-weekly. So a pro tip for recipients, you need to make sure you understand the difference. Bi-weekly means every 2 weeks. Since there are 52 weeks in a year, that means you receive 26 payments during that year. Conversely, semi-monthly means 2 times a month. Since there are 12 months per year, that adds up to 24 payments. The difference is 2 payments per year. So a biweekly recipient that is calculated on a semi-monthly basis may be over withholding, whereas a semi-monthly recipient that's being withheld, that are having taxes withheld at the bi-weekly rate, may be under withholding. So that's a note for employers to consider, or sorry, the payers to consider, so the pension or the annuity company. But that's something that you should keep in mind. So let's go through step 1A, which is the total payment this period. I kind of worked backwards in populating this field, starting with the $48,000. We're assuming that he's receiving monthly payments because that's what it said in the PowerPoint. So that amounts to $4,000 per month times 12 months. That equals $48,000. This would be kind of a quick fact check for you if you were working backwards. This is how you would be able to determine, whether or not this is being done correctly. You can actually do this yourself and then see if the numbers match up. So if there is something peculiar about your payment, you can pull out worksheet 1B and work through this yourself. In the next step, we're going to go through, there's a decision point. If the payee has submitted a Form W-4P for 2022 or later, then you're going to use steps 1D through 1I. If the payee did not submit a Form W-4P for 2022 or later, and the payer is having to use an old form, then they would use these steps right here. They would use one or the other, but not both. In this case, we're assuming that John Doe completed his W-4P for 2022 or later, so this is how that works out. And remember, the Form W-4P had nothing but zeros, so any steps that were entered here, we're going to enter 0. That means $48,000, no extra sources of income to calculate withholding for. And then step 4B is the deductions, so no additional adjustments for the deductions. We're claiming the standard deduction. And then in line 1G, we've entered $12,900 since they're filing married and jointly. And we combine that to come out to $12,900. And then we subtract this amount from the $48,000 and we end up with $35,100. This is known as the adjusted annual payment amount. So now we're on to step 2. Step 2 is figure the tentative annual holding amounts, and that is broken down into 3 parts. Part 1, again, if the payee has submitted a Form W-4P for 2022 or later, and step 2B3 contains a non-zero amount, then you would complete lines 2A through 2C and then resume on line 2E. So let's isolate part 1 because we'll use this information to populate parts 2 and parts 3 in just a moment. So let's start here. And again, because everything contains zero amounts, we're moving on to line 2D. Either or, but not both. So if you completed line 2A through 2C, then this line 2D should not contain any information. So we're bringing down the $35,100 from line 1I. And now we used a withholding rate schedule that's located in the annual percentage method table. This is a table that is in publication 15T. You can look at it if you want. I'm not going to show those tables here. These are the values that came from that table. But basically, this is based on marginal tax rates and tax brackets. So the number that corresponds to this is $16,300. These are the numbers that correspond to all of that. So when we get down to it, basically we're withholding $1,880 as of the end of part 1. So part 2 is highlighted. We would complete part 2 if there was an amount on line 2A above here. And again, line 2A means that there were other annuities or pensions that we need to calculate additional withholding for. Since that doesn't apply in this case, we don't need to complete part 2. We're going to skip down to part 3, where we combine parts 1 and parts 2. Since there's no part 2, we simply carry this number down, 1880. Now part 3, this is where we account for tax credits. So in this case, the payer would subtract any tax credits that were entered into step 3 on the Form W-4. And there are no tax credits that we're looking to claim, so we're simply going to carry the 1880 down from that, and then we're going to go to step 4. And step 4 is determining the final amount to withhold. We're going to take that 1880 and we're going to divide this by the number of payment periods from line 1B. And if you recall, the line 1B, we're getting paid monthly, so we're going to calculate this 1880 on a monthly basis. If John Doe had entered any additional withholding requirements on step 4C of the Form W-4P, then we would enter that here. So for example, if he had entered $50 per pay period, then we would be adding $50 as a deduction to each pay period. We would be withholding a total of $206.67, per month, and then that would result in an additional $600 of withholding for the tax year. Now, if John was being paid semi-monthly, then the $50 that he put on the Form W-4P would be applied twice a month, which would make that $100 per month or an additional $1,200 per tax year. So again, be careful on what you enter into these numbers, because they are the forcing mechanism for your payer to walk through this worksheet. So if you did enter that extra $50, that $50 per pay period is maybe what you expected if you were receiving monthly payments. In the back of most people's mind, $50 per month equates to $50 per pay period if you're receiving a monthly pension. But if you receive your pension amount or annuity amount twice a month or every 2 weeks, then that number will be applied every time you get paid. So that's all I have. I hope this was a little bit helpful. This is a reference for me. It definitely, walking through all of these different steps and then trying to backtrack them on the instructions in publication 15T helped me reach a better understanding of how this math works. So we'll put links in the show notes to other articles and videos that we've written on this and similar topics. So if you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions, comments, if this was useful to you, if you'd like to see more case studies, please hit me up in the comments section. Thank you very much and have a great day.